And now for something completely different.
It's a rich man's world.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
Are out this morning, Kravis, Kohlberg, and Roberts. They're nothing to do with me, by the way. I wish. Out with their mid-year outlook and talking about, higher oil prices for longer and, the inflation outlook, et cetera. It's interesting because, we've got two things that are kind of going on. And look, the White House wants to blame at this point what's happening with Russia for the oil price inflation that we have. But really, this all has been occurring now for quite some time. And this started, for the most part, when Wall Street declared war on the energy companies. And they did that through this ESG investing. And Mike and I have both written articles about, the fallacies of ESG. And first of all, it's as we've said before, it's great. If you want to be environmentally friendly, then go plant trees, right? That's how you actually impact the economy. Recycle your trash, do those type of things. That's how you can impact the economy. Just buying shares from shares of stock from somebody else doesn't impact economic growth. If I buy shares of Apple today, Apple has no idea that I bought shares of Apple, and they're not going to change any of their policies of employing, young girls to, put, chips on phones in China. That's not going to change any of that, right? It's just, we're just trading shares between ourselves, and that's all that goes on. So ESG, really has no real foundation in helping the climate or anything else, but it's great for greenwashing for Wall Street. They charge more for the same amount, for the same exact funds. In fact, a lot of mutual funds that had funds out there that were not getting money flows. It was a large cap value fund, and it was not getting any fund flows because their performance was terrible for whatever reason. They just simply changed their name to ESG, and all of a sudden they started getting fund flows, right? So it all became a big marketing scam for Wall Street. But the problem, importantly, and we saw this back in the late 90s with sin stocks. Back in the late 90s, it was not a good idea to invest in companies that were investing in things like, casinos and alcohol and tobacco and pornography, this type of thing. So all these virtual kind of signaling that was going on back in the late 90s, we weren't going to invest in sin stocks. And so everybody kind of started avoiding those. And those turned out to be some of the best performing stocks on the planet. Ironically, ESG was supposed to be the companies we don't want to invest in, and those have been the best performing stocks over the last 2 years by a large margin. And that's always kind of the way it is. But importantly, Wall Street and the White House created an environment that has made it non-favorable for oil companies to do their job of drilling for oil. And this has been a big drive. BlackRock in particular has a lot of influence. They manage trillions of dollars of assets. They manage a lot of money for big pension funds. And they've been pushing their pension funds, CalPERS and others that they manage money for, to divest themselves of oil stocks in their portfolios. Well, that removes capital from the market that's available, that capital formation that oil companies need to go out and invest millions and millions of dollars into developing an oil field or an offshore oil well or whatever it is. So if you want more production, they need capital. And if you're extracting that capital from them, then that gives them less capital to work with. So that's one impediment. And then you reduce, and when Biden took office, he restricted millions of acres of land from drilling. He made getting permits much more difficult to go drill with. And then, of course, he shut down the XL pipeline, which reduced oil supply into the U.S. So all of those things combined have made a very negative environment for oil companies to drill. So obviously, the problem is, and Mike has written some articles about this, and I've got an article coming out next week, the number of drilling rigs that we have are rising. but they're not rising nearly at the rate that we saw the last time that oil prices were over $100 a barrel. So companies are drilling. They're just not ramping it up because, as we said earlier in the show today, that visibility is not there. So it was interesting. The American Petroleum Institute sent a letter to the Biden administration laying out 10 things that can be done to increase oil drilling. And this is what President Biden wants, right? The president and his spokesperson have been attacking oil companies for the last couple of days. Y'all need to produce more. We're going to implement the Defense Production Act, kind of pulling a trick from the Trump administration to get more production of oil. You're going to try to force these companies to drill. You can't force a private company to drill. You just can't. But it sounds good. You know, it's a good soundbite, but you can't force the company to do it. But here's their 10 things. Lift develop, and this tells you what's been done to the oil industry over the last couple of years from this administration. Lift development restrictions on federal lands and waters. Designate critical energy infrastructure projects. Fix the NEPA permitting process, right? Can't get a permit. Accelerate LNG exports and approve pending LNG applications. Pending LNG applications. Companies, and my wife works for an LNG company, can't get approval, right? They're sitting there. Applications are there. Nobody's approving them. Unlock investment and access to capital. Again, Wall Street's been declaring war on energy companies. Not surprising. Dismantle supply chain bottlenecks, advance lower carbon energy tax provisions, protect competition and the use of refining technologies, and permitting obstruction on natural gas projects. Kind of an obvious one, and advance the energy workforce of the future. So these were just 10 that the American Petroleum Institute came out with and said, look, if you want us to drill, you've got to give us the environment to drill with. And as we said before, is that companies, if I'm going to invest capital and if I'm going to invest $100 million to build a refinery, I've got to have enough window into the future that I can say, okay, if I invest that capital today, am I going to get my money back? And right now, they simply don't have that visibility. In fact, just recently, one of the big oil executives says there will never, this is a pretty strong statement, he said there will never be another refinery built in the U.S. Never. And there's your big problem. Mike, what's your thoughts on this?
I think here's the sad part. If your goal really was to get off carbon energy as much as you can and move to alternative sources of energy, you need to encourage the inventions for these new sources of energy. And what's the best way to do that is to have $10 gasoline, right? In theory, if they really cared more about the environment than they do winning an election, they would actually like higher gas prices because it makes owning electric cars more economically feasible. It makes exploring for hydrogen alternatives more feasible. It provides and it encourages someone to come out and find a cheaper source of oil. When gasoline is $2 to $3 a barrel, it's hard to beat that. It's just the cheapest source of oil there is, and you need all kinds of subsidies to try to encourage this. Right. So on one hand, they're saying we're green, we're the green, everyone's green, except they're not green when it comes to paying the price for being green. And there's a price somewhere between now and who knows when, 2030, 2050, 2090, we may switch entirely to some new source of energy. But it's not going to be easy, and there's going to be a cost to that. And by trying to get oil back down to $2 a barrel or $2 a gallon, you're really encouraging people to not explore the alternatives. So figure out what you want to be. Do you want to win the next election, or do you want to be green? Yeah,
but there's another huge problem with the whole theory, right? I want to be green. I want to have all these other alternative sources of production. Okay, fine. No problem with that. It takes a tremendous amount of oil to produce a windmill or solar panels or electric cars. The carbon footprints on all these things are pretty, enormous. So if I switched all these other things, and here's the point, and the argument is, but once it's produced, then you don't need oil anymore. That's great, but you got to keep producing this stuff. And so as you begin to move these other sources and you start to kill off the energy companies, then the input costs for building these things become astronomically more expensive. So again, the cost efficiency of these things really don't show up And these are some of the things that people forget about. It's like, yeah, but once it's produced, then I get cheaper production in the future. No, because all the other input costs are going to go up because oil's in everything. You cannot name one thing that oil does not touch. A head of lettuce. Well, no, you got to ship it from point A to point B, right? There's oil in everything, from the clothes you wear to the computers you use to the food you eat. There's oil and petroleum involved in everything. And so you can't get away from it. But the more that you restrict that production and the more you demonize it, the more you increase the cost everywhere else. So the idea of being all green is fantastic. You really honestly can't afford it because it's non-efficient in terms of the form of energy production.
Right. It's the whole energy policy is kind of warped, and it's warped around this green climate initiative. And I get it, right? Let's try to do what's best for the climate, but maybe what's best for the climate is to keep producing oil, come up with other ways of sequestering carbon, plant more trees. There's so many other things we can be doing, but we have to admit at some point that our economy runs on good old-fashioned oil. And it affects, like you said, everything, Lance. And that's the approach we have to take, is how do we work around that instead of trying to demonize that and come up with some alternative that's not really much better.
Yeah, exactly. And but again, these are lessons we learned, and we kind of swing that pendulum in one direction or the other, and then eventually we find some middle ground that makes a lot more sense. And we'll get there to that point. Unfortunately, looks like we're going to have to go through some pain first to get there, as always is the case. All right, that wraps up the show for the day. 3 minutes on markets is coming out. We'll give you a market update today, where we are after yesterday, what happens this morning with the open. Markets looking to open down fairly sharply, down 566 right now on the Dow. So it's going to be a pretty tough opening. We'll see if the markets can try to get some recovery later on today. In the meantime, get by the website. Latest article is out on the websites as well. That's Michael's article from yesterday on financial instability. And, of course, our daily market commentary is up on the website as well. All right, that takes care of it. Be back tomorrow. Have a great day.
It's a rich man's world. It's a rich man's world.